Are you tired of paying rent every month and not seeing any return on your investment? Have you ever dreamed of owning your own home and generating passive income? If so, you are in the right place. Welcome back to Invest in Jersey. My name is Gohar Grigorian, your trusted guide in achieving your financial freedom through investing real estate. If you're new here, don't forget to click the subscribe button and turn on your notifications so you don't miss any of our episodes. Today we are going to talk about a topic that most of homeowners love to hear, FHA loans, where you can buy 2 to 4 family home, live in one unit, and then use the other units for investments. If you are ready to become a homeowner and also be a landlord, then this episode is for you. Let's get started. I am going to introduce you my guest speaker, Shalene Matani, Vice President of Guaranteed Rate. Shalene, it is a great pleasure to have you here today.
Thank you, Gohar. Pleasure to be here with you as well.
Thank you. So let's dive right in and talk about let's start from the basics. What is FHA loan? For someone who have no idea, let's explain.
So FHA was created by HUD in 1934, really to expand home ownership. And the concept behind it is that to allow more people to qualify for a mortgage. So a lot of times you might not have the perfect credit score, or you may not have a big down payment, or your debt to income ratio may be a little bit higher. FHA has a leniency factor that allows those buyers to purchase a home.
One of our clients are looking to buy a 2 to 4 family home for investment. Can they use FHA loan?
You could not buy a multifamily and be a straight investor and qualify for an FHA mortgage. But what you could do if you're buying a 2, 3, or 4 family property and you intend to occupy in one of the units, it is considered a primary residence, and then you can purchase using an FHA loan should you be interested in a multifamily residence.
Perfect. But this way, if someone is qualified for less amount, if they're buying 2 to 4 family home, they will be qualified for more, right? Tell me more about this.
Yeah, so what happens is, the rule of thumb is basically if there are multiple units that are available for rent, we take 75% of that rental income for unit 2, 3, or 4, and then we add that to the income for your buyer. So as a result, yes, if I use the additional rental income, I can qualify for a higher purchase price than if they were purchasing a single family alone.
That's really great, because this opens up opportunity for a lot of buyers to go at a higher price point, where initially, like maybe whatever they can afford, they can really find anything in this market. But at the higher price point, if we can find them something that can bring them extra income, they can also be a landlord and the owner both at the same time.
Absolutely. Really, it's a great product. It opens so many avenues of lending, and there are so many reasons to consider an FHA loan.
Shalene, let's talk about the down payment requirement, because this is a big thing, right? A lot of buyers, they think, because it's a 2 to 4 family, they might need more down payment, or credit scores we would need. My credit score is really not as good as they're thinking that they need to fix their credit score before they consider buying something bigger. Let's share some information about that.
Sure. So when you're looking at an FHA loan, it's very important to think about what are the guidelines for a owner-occupied single family and then a 2 family. So the 1 and 2 family have very similar guidelines, and then the 3 and 4 family have different guidelines. So when you're looking at a 1 and 2 family residence, typically that down payment requirement is 3.5%. So your clients can put 3.5% down to purchase that property. There are certain options that might be available where they might be able to get a second mortgage on top of that 3.5% down payment. So essentially, they only are paying for their closing costs. Wow. So that is a very unique program that we can offer. But if you were to think about your clients looking to purchase a home, if they're looking for a single family or a 2 family, 3.5% is quite the norm.
Perfect. So let's say one of our clients, they're looking to purchase, their income is not enough. Can they bring a cosigner?
Yes. In an FHA loan, you definitely can bring a cosigner. You do need to have a cosigner only on a single family residence though. If you're looking to purchase a 2-family, instead of a cosigner, we would use the rental income on that second unit. But to qualify for more income, you could have a cosigner that doesn't occupy the residence to help you qualify for the mortgage.
That's a really great benefit to know. And let's just talk about a little bit in detail what cosigner actually is and what their role is, because I know sometimes when the clients are trying to find a cosigner, right? In the beginning, the cosigner agrees that yes, I will cosign for you. And then during the process, they change their mind, which can cost a lot of money and stress to our clients.
Yeah, absolutely. So, the cosigner, right off the bat, during the pre-approval process, I do have a conversation with the cosigner. They need to understand that when they cosign for a mortgage, that mortgage is going to appear on their credit report as well. Now, a lot of cosigners can choose to be on title, or they can choose just to be on a mortgage alone. But in an FHA loan, you do need to be on title if you're on the mortgage. They understand that this is going to be on their credit report. They understand that we're utilizing their income to qualify for the mortgage. A lot of times with the cosigner, I get the question asked that what happens in the future if they want to buy a property, right? So typically, if you cosign for a debt for someone else, you need the buyer needs to show 12 months of mortgage payments that they have made, so that they are responsible for. So we exclude that liability from the cosigner in the future.
That's great. And actually, one of my clients, she's doing exactly the same right now, because she did help her parents to buy the home. Now she's buying it for herself, but then it shows on her credit that she does have that mortgage. Now what she needs to do, and she already did it, she's showing the parents' bank statement for the 12 months. So this way they know that she is not making the payments. The purchaser who purchased, they're making the payment.
Absolutely.
Yeah.
Really a great option.
Let's give our viewers what kind of credit scores they need to qualify for this loan.
Yeah, so FHA is great because it's actually the only product that allows a buyer to purchase a home with a 580 credit score.
Wow.
So there are requirements. They have to have limited payment shock if they have a 580 credit score, and they do need to have reserves. Basically, we as your lender need to ensure that they're not biting more than they can chew.
Mm-hmm.
The mortgage payment is something that they can afford to make.
Yes.
And if they have collections on their credit report, as long as it's under $2,000, we can exclude that collection. If they have medical collections in an FHA loan, we can exclude those medical collections as well. So it does allow for purchasing a home at a 580 credit score. The normal requirements, though, are 640 as a credit score. At 640, we are not limited by payment shock, and we don't require additional reserves in an FHA loan.
Perfect. Talking about reserves, how much reserves they need to have to get started?
So typically it's 2 to 3 months of their housing payment. Housing payment includes principal, interest, taxes, insurance, and the mortgage insurance premium. So they do need to have between 2 to 3 months of that as a safety net. And we can even use retirement assets. So it doesn't all have to be liquid. We can use what they have in their 401k or their IRA as well for reserves.
Can we use a gift?
We can use a gift for the down payment and closing costs.
Okay.
And use your own money for reserves.
And who can give a gift?
So the gift can be mom, dad, aunt, uncle. You can't get a gift from a close friend because, the concept is which friend really gives you a large sum of money, right?
Yes.
So typically it is a blood relative that can provide a gift.
Okay. That's good. That still gives an option to, be able to get more if you need it for the closing,
Yeah.
or, it's still a good help.
And what's really great as well in an FHA loan, if they put 3.5% down, you could actually negotiate a 6% seller assist towards closing cost. And that's not available in the conventional loan. And what's great about that, supposing the closing costs tend to be a little bit higher, if interest rates are a little bit higher and the buyer wishes to pay points to bring the interest rate down, the seller assist can really help the buyer pay for all those closing costs and also reduce your interest rate.
Wow, that's amazing. Tell us a little bit more about that seller's concession 6%.
So what's really good is that, in an FHA loan, let's say you're looking to purchase a property that's about $500,000, right? In our area, if you're looking at property taxes of about $12,000 a year, essentially your closing costs will range around $14,000 to $16,000. Now, on top of that, if the buyer just has a limited down payment and all they can do is put the money towards the down payment for the home, you can negotiate the seller's assist. So for example, you can negotiate either a $15,000 seller's assist towards closing costs, which tends to be 5% of the sales price of the home. And this way, the seller can just come up with the down payment, but the closing costs will be covered and paid for by the seller credit.
A lot of our clients, they ask about timeline, right? With the FHA loan, they think that most of the time FHA loans takes longer and there are extra steps involved, or the appraiser may not come as it should be. So there are all these concerns when we're saying, FHA is a great option to work with. And also, the sellers too, when they hear FHA, they're a little hesitant of taking the offer. So let's explain, all this gray areas of the timeline and the inspections and the appraisers, and how we can make this happen like smooth and in about 30 days.
Yeah. It's such a misconception that FHA loans take a long time, right? We actually are able to close an FHA loan in under 3 weeks. Very normal.
That's why I said it about 30 days.
Yeah, so closing in 30 days is absolutely not a problem. So what happens is, in an FHA loan, the appraisal. The appraisal is no different than the appraisal on a conventional home. But in an FHA home, the appraisal has to make sure that the property is sound, there are no repairs. Basically, nothing can be wrong with the property that can impact, the safety of the home buyer.
Yes.
So if you see a railing that's loose, or a stair that's loose, or if your deck is missing a side railing, all that will have to be repaired. But the appraisal process is not any longer. In a conventional loan or an FHA loan, the appraiser has to look at what's sold in the last 6 months, and they look at comparables based on what's sold. So it does not mean that the FHA loan will appraise less just because it's an FHA loan. It follows the same exact guidelines as it does with the conventional loan. The key is that it needs to ensure that the property is safe and livable. Now, in terms of the underwriting process, also very similar. In terms of the underwriting process is very quick. We've had an FHA underwrite happen in under 3 days. As you're waiting to do the appraisal, your client will go through the underwriting process and get the loan approved. And then when the appraisal comes back, we issue the mortgage commitment. So there is no anticipation at all for any delays just because they're doing an FHA loan.
What I would add to this is who you work with matters.
Yeah.
Because it also depends who is the person behind the scene working on these things.
Yeah.
Because there are some companies that they will take the paperwork, the documents, the process that will make it very long process. Not because the FHA is taking longer to get it done.
Yeah.
It's just whoever is working on it, they're not taking their right time to finish it.
And it's so funny that you say that, but in our business, right? You being a top realtor, me being a mortgage lender, it's so important. Experience matters.
Yes.
Right? Experience matters. Understanding the client matters. Understanding the area that you're lending in matters, or the area that you're selling in matters, right?
Absolutely.
So what happens is because we are so experienced, our clients can expect that their process is a lot more smoother than working with somebody less experienced.
I agree. Charlene, I heard that when let's say our buyers are buying 2 to 4 family home, there's a test that they need to pass to qualify to buy investment property. Tell us more about this test, what it means.
So when a client is purchasing a home and it's a 3 or 4 family property, and they still wish to put the 3.5% down, there's a test. It's called a self-sufficiency test. What that means is that on a 3 family or 4 family, where the buyer is looking to occupy 1 unit as your primary residence, but getting rental income on the other units, the way to look at this test is that we look at the total rental income that the other 3 units can get. So, and then we give a 75% ratio. So we cut 25% for vacancy.
Okay.
So let's say if they purchase a property and the rental income is $5,000, what we'll do is we'll haircut 25% of that rental income. The housing payment, the mortgage payment, principal, interest, taxes, insurance, mortgage insurance premium has to be equal to that rental income. So it's considered a 1-to-1 ratio. And if it's not a 1-to-1 ratio, then the buyer has to put a bigger down payment.
Okay.
In order to get it to a 1-to-1 ratio.
Okay.
Really, the whole concept behind it is that in an FHA loan, if somebody is purchasing a 3 or 4 family property, the rental income should cover the mortgage payment.
Yes.
And if it doesn't, then you calibrate that by putting a bigger down payment.
So basically, after that test, we will clarify if we need a bigger down payment or 3.5% would be enough to move forward.
Absolutely. Absolutely correct. So either one or the other. So if you're thinking of a property that might be a little bit more higher in price, and the rental income is great, I can do a calculation for your buyer during the pre-approval process to see if that rental income will cover the mortgage. So this way there are no surprises. They don't go into the mortgage process, they don't pay the appraisal, and then find out that they have to put a big down payment.
To happen. Yes. Yeah. I always tell my clients when we find something and they're interested to submit an offer, even before submitting an offer, right? I help them with the calculations and I connect them with you to make sure that the numbers match. So this way we know everything before even started, right?
Yep.
Like, how much rental income we're gonna get, how much are the taxes, how much are the insurance, what will be the other units. So all these things, being calculated even before submitting offers. So we know we don't want any surprises, the mortgage comes out higher and then you have to come up with extra money from your pocket, which as a first-time home buyer, you may not have.
Absolutely, yeah. The due diligence goes a long way.
Perfect. Thank you so much, Charlene, for being here today. And thank you for sharing all this great information. I'm sure this can help many of our viewers to make a, right decision.
Yeah. Thank you, Gohar. Thank you, homeowners, home buyers, for allowing me to spend some time with you today.
We have an offer for our viewers. If you're watching this episode and you're thinking about, buying a 2 to 4 family home with FHA and you're not sure where to start, you can click the link below and set up a consultation with us where we can take your scenario and guide you and give you valuable insight for your specific needs and how to make your dream reality.